This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today's show is going to be great. We're talking with a West Coast real estate investor, Chris Freeman, who has a background in high-tech sales that has used his industry experience to help create more efficient workflows, and also how to identify and get out of markets when they're not working for you in commercial real estate. So definitely stick around for that. But today on the download, we have some interesting news from our favorite CEO, Elon Musk. Put out a Twitter poll over the weekend, and maybe he wasn't exactly expecting the results, but the Twitter poll was essentially asking if he should step down as Twitter's CEO, and the internet does what the internet does, and by a 54% vote, the people have spoken. They said that he should step down. Now, it will be interesting to see if he actually takes the poll at its face value, but he has indicated that he is now searching for a new CEO to head the large social media giant Twitter. But again, we'll actually see if this actually comes to fruition. This does come on the heels of him actually seeking additional investors at the share price of $54.20 that he acquired Twitter for in private offering. So this might indicate that Twitter is in a bit of a capital crunch. Elon Musk has also reported the sale of another significant chunk of his Tesla holdings. Whether he is going to plug this capital into Twitter or maybe SpaceX or the Boring Company, it remains to be seen. But there could be some indications that Twitter is in need of capital by virtue of what's happening. So it'll be interesting to see how it plays out. But, with it being a private company, it's much less of an effect on the broader markets. But it could actually be seen to drive more business, if Twitter's not doing so well, to other social media platforms that might actually have an effect on the marketplace. Again, we're also waiting to see what's going to happen with the potential ban of TikTok in the United States, which could significantly help increase the share price of companies such as Snapchat and Meta, the holding company of Facebook and Instagram. So with the mix-ups that are happening right now in social media, which more or less is kind of an indicative marker of marketing within, or I should say, which is more of an indicator of marketing dollars being spent in the United States. So it'll be really interesting to see how all of these things play out. But as of right now, things are kind of remaining stable, albeit significantly down from the beginning of the year trading with companies like Snapchat and Twitter, Snapchat and Meta. So it remains to be seen how this is actually going to affect the broader markets, but there could be some positive plays to be made a little bit later on after a few of these things actually settle. Real estate development in the United States. What a story this has been this year. Not too many good things are happening, and it's fortunately with the third straight quarter, we have seen housing permits drop, this time by 0.5% from last quarter. And unfortunately, this is a really shocking thing that I found doing the research for the intro, is that this is the lowest permit pull. So essentially, real estate developers pulling permits for new housing builds since May of 2020. That is absolutely wild. So again, this is going to be a little bit of a lagging indicator with the Federal Reserve continuing to raise interest rates, although the last interest rate hike that we just saw last week was only 50 basis points as opposed to the 4 consecutive previous rate increases of 75 basis points. So we are seeing the Federal Reserve start to cool off on how much they are actually raising interest. And with the CPI numbers, or the Consumer Pricing Index numbers, which measures household inflationary markers such as energy, groceries, and other household items, that is also seen to have been slowing down, still increasing, but slowing down. So hopefully this is going to mean that the slowdown in the new housing development is also going to, again, cool off, and maybe that the building is going to commence again. But right now, essentially, we're still kind of directly on the downhill side of this thing, and who knows how long it's actually going to take to recover. But hopefully sometime within 2023, I would imagine sometime probably in the third or fourth quarter of next year is when we'll start to see all of this stuff rebound. The fallout from the humongous scandal at FTX, the crypto trading platform that was headed by Sam Bankman-Fried, is still continuing to have ripple effects through the entirety of the crypto markets. There really isn't any indication out there that there is anything other than a fierce bear market happening across all cryptocurrencies, with the stalwarts such as Bitcoin and Ethereum still seeing a relatively steady decline in price, with both of them trading at year lows right now. And with Sam Bankman-Fried now having been arrested and is facing extradition in the Bahamas, unfortunately, it's going to be a long, protracted battle to see how much investors can actually recoup from this humongous bankruptcy and what could potentially, depending on how the courts play out, maybe some fraud involved in that as well. But again, we will certainly have to wait and see what the courts have to say on that, and whether that the ultimate culmination of all these court cases and his arrest will have any positive impact on cryptocurrency. But right now, it is hard to be a cryptocurrency investor. So keep your eye on that. I mean, again, with the markets declining, maybe now's a good time to buy. People were kind of losing their shirts when they were buying Bitcoin at $60,000 and it's trading at $16,000 right now. So, maybe now is a good time to get into it. But again, with it being so inherently volatile, it is something that investors should always make sure that they're doing good, solid due diligence before entering into that specific market. Something really interesting that I found today that is very, very recent news that unfortunately we really won't see what ripple effects it has into the broader markets is that the one of the largest exporters of raw uranium ore, which is Zimbabwe in Africa, has effectively frozen all exports of raw lithium ore and refined lithium metal at all. They aren't shipping any out anywhere. This isn't just a small embargo. They have effectively shut down one of the largest world suppliers of lithium metal, which of course is the key component in making industrial grade batteries for electric vehicles, lithium ion batteries. You hear that term all the time. Well, the lithium has to come from somewhere, and a large chunk of it comes from Zimbabwe. Now, what Zimbabwe is effectively trying to do, what their finance minister said, that this is actually being done in good faith, and what they are trying to do is promote more production of finished lithium products within their country. So having battery manufacturers actually come to Zimbabwe, manufacture the batteries in country, so that way they can have, additional industries, they can, create additional revenues, jobs, infrastructure in that country surrounding this highly valuable rare earth element. So this is, again, kind of breaking news coming out this week. And, we won't see the prices of cars, start to go up, for at least a month or two, once we kind of see how firm that Zimbabwe is going to stand on this trade embargo with the rest of the world when it comes to lithium metals. But I can imagine that we can very well expect to see a large price increase in the cost of anything that uses these lithium batteries, which is going to be things as small as cell phones. Cell phones costing $1,000. I wouldn't necessarily say that they're small, but everything from cell phones to your video game controllers to electric cars is going to see a price increase with the actual supply of lithium being so constrained if this does actually play out for a little bit longer. But some good news when it comes to raw materials and energy and all that kind of stuff is that Oman and several other Persian Gulf countries are indicating that they anticipate an increase in oil production in 2023, which of course will help pretty much anyone that has to fill up a vehicle or heat their homes this winter, with which essentially, supply and demand, increased supply is going to drive costs down. So hopefully people can start getting some relief at the pump and on their electric bills as well. But unfortunately, this might just be a little bit of posturing on behalf of some of these countries. We've seen this before, so we don't actually know what's going to happen until OPEC has their next meeting and actually sets global production standards for all of this. So hopefully we'll get a little bit of relief for those of us that still drive gasoline or diesel powered vehicles at the pump. Great thing in Florida, we're seeing gas in the $2 a gallon range. I know I just had some people visit from out in Arizona and they were seeing $5 to $6 out there. So it's a large disparity across the United States and the world with how much actual gasoline costs for vehicles. And of course, that translates into electricity production and all sorts of other things, shipping and the like. So we'll see what actually plays out once OPEC has their meeting and sets global production standards. And hopefully this will, lead into some decreased costs for people and hopefully try to get those inflationary measures down so the Federal Reserve quits hiking up interest rates at every opportunity they get. With that said, this has been The Dow. Today on the what is comparative advantage? Comparative advantage is an economy's ability to produce a particular good or service at a lower opportunity cost than its trading partners. Comparative advantage is used to explain why companies, countries, or individuals can benefit from trade. When used to describe international trade, comparative advantage refers to the products that a country can produce more cheaply or easily than other countries. While this usually illustrates the benefits of trade, some contemporary economists now acknowledge that focusing only on comparative advantage can result in exploitation and depletion of a country's resources. The law of comparative advantage is popularly attributed to the English political economist David Ricardo in his book on the principles of political economy and taxation, written in 1817, although it is likely that Ricardo's mentor James Mill originated the analysis. This has been Comparative Advantage on the What Is. Welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, and today we are pleased to welcome Chris Freeman. Thank you very much for being with us today, Chris. We're going to get some really good insight about commercial real estate and some maybe some different angles that people really haven't heard about. More often than not, that we talk about just the just the awesome successes. Looking at everything through rose-colored glasses. We really don't often hear too much from people that have had struggles and then overcome those. And, I think a lot of people, when they look at something as daunting as commercial real estate, whether you've been in it for a long time or you're just trying to get into it, I think most people are kind of relatively pragmatic and thinking that, it's not just going to be this easy path. You're going to run into things. Well, so often people talk about, it's like, hey, here's how to do things and be successful, not how, hey, here's how, when you identify problems, how you overcome them. So I think Chris has got a really great story today. And with that said, Chris, maybe give us a little bit of background on yourself, and then we'll dive into, your journey through commercial real estate.
Yeah, thank you, Alex. And thanks for having me on the podcast. Really appreciate it. Yeah, so my name's Chris Freeman, and I'm based here in Portland, Oregon. And I'm not a full-time commercial real estate person. I'm actually still in a high-tech sales leadership role. I've been doing that for 20 years. But during that entire time, or really for about 21 years, I have been investing in multifamily real estate, doing kind of smaller, medium-sized apartment buildings here in my backyard, 8-unit, 10-unit, 15-unit, 20-unit type of buildings. And I've just been cranking away on that for 20 plus years, and definitely have expanded and doing larger deals and syndication deals as we look to get out of the Oregon market. But, I've always looked at real estate as an opportunity to clearly diversify from stocks. But I got exposed early on to a person who ended up being my future partner when the dot-com bubble hit. I was young and I'd made some easy commissions. So I had invested it, and all my stock was in high-tech companies. And I watched all of that crater in the dot-com bubble. And unlike the Great Recession, where companies came rip-roaring back, a lot of those dot-com companies went to zero and never came back. And at that same time, I was watching my father-in-law, who had already been in real estate for like 50 years and owned buildings here locally, had them all paid off. I'm watching him making 300 plus grand a year, and he's not missing a beat, while some of his retired friends that were on fixed income are all kind of hunkering down during that period of time. So that was, for me, at a really young age, a great opportunity to get exposed to what could be. And that's really when I made the pivot, that beyond my 401k and my matching that I would get from that, everything else went into real estate in some form.
Yeah, we get a lot of that from people of seeing, kind of the cash flow benefits of real estate. It's something that I preach, and pretty much everyone else does. So if you're listening to this and you're interested in getting into real estate, take that for what it's worth. It's, when you start to see commonalities amongst many different viewpoints, is when you can kind of maybe glean some things that are probably important to pay attention to. So, you kind of start to see, the benefit of real estate, going through I can't imagine what going through the early 2000s and high tech anything would have been like. So congratulations for making it through it and still being in the industry.
Well, thank you.
So from there, like you said, you started kind of investing in your backyard. So what are some things that, you started to do, and what time frame was this? Like when you first started doing like your commercial real estate, and you said it was Portland, right?
Mm-hmm. Yep.
Yeah. So like when you're starting to invest in Portland, starting to get that, getting some traction in investing, what are some things that you started kind of running into in that particular market, and what time frame was that as well?
Yeah, it's interesting. So, early on, when I first started, I didn't know what I didn't know. And so I was just kind of happy to be investing, period. And so, after the duplex that I house hacked, our first really bigger move was we bought a 15-unit property. We did a 1031 exchange from some smaller, I guess actually it was my duplex that we 1031 exchange in this 15-unit building. And that was going great, right? Making cash flow and, definitely kind of a Class C, affordable housing type of offering. And, I was a hustler. So I would get down in the trenches. I would get tenants in there. I would go do whatever it took to quickly get it rented, because we were very hands-on. We were doing all the property management, all the maintenance. It was just me and my partner. We didn't have any property management. And it was really amazing because in the early days, I would have tenants that would thank me for the unit. They would thank me for the speed at the maintenance that we delivered. They would thank me for really the affordable housing. We weren't cheap on our rent, but we always kept rents maybe 10% below market because, the idea was at that time, hey, if we can avoid somebody moving out, that's going to save us a ton of money. And that was working well for, let's say about, 8 years, 10 years. And I can't tell you exactly when it happened, but at some point, the whole dynamic and relationship with the tenant started to change a little bit. And this is specifically to Portland. I'm not speaking elsewhere, but it went from tenants thanking us for the great deal that they were getting, thanking us for the maintenance, to at some point, tenants started sending over maintenance requests with some statute of the law on why I need to do it. They would ask for stuff and then threaten lawsuits. It's just the whole kind of relationship with the tenant changed. And it's not so much really the tenant's fault. It was the environment that the city and ultimately the state, but really more the city created over time with some of their tenant laws, some of the rules. It really kind of became more of a lopsided environment with all the balance being in the tenant's favor. And so that really created a lot of operational challenges for us, created more risk. We had one lawsuit where we had a plumbing problem, took a long time to fix, and the fix didn't work, so we had to go back and do it. And this person wasn't even in Portland, but they went and found a Portland lawyer and then filed suit. And I remember at that time there was we kicked it over to insurance, and so the process was you get with the attorney and you got to go get all the records and all the communication and so on. And we really didn't do anything wrong, but when we were sitting down with the attorney, what they said was, doesn't matter. You get in front of a jury, they're never going to side with the landlord. They're always going to side with the tenant. And so we just have to find a way to settle. I mean, it wasn't huge, but it was a chunk of change that if we didn't have to spend it, we would have rather kept it. And so that's just kind of a little bit of a story of how over time it changed the profitability of running a property here in Portland.
Sure. So when you say the profitability, are you saying just from the fact that you had to, you had a settlement that you had to pay, or is it just the fact that you were now having to hedge on so many more things? Like you were paying out additional insurance premiums, or what was was it kind of that mental edge in there, just saying hey, this is eventually going to happen again? Or were there other monetary things that kept chipping away, after that kind of paradigm shift of, tenants starting to rely more on, there's really no other kind of better alternative, kind of the ambulance chasing mentality of, some of these tenants and attorneys when laws change. Were there some specific expenses, or was it just one of those kind of writing on the wall things after that you just started seeing and you're like, okay, it's only it's not a, if it's a more of a, how much sooner when is this going to happen again?
Yeah, well, definitely. Premiums have gone up, but I think that those have gone up for everybody everywhere. We ended up having to shift to professional property management. And so that was an additional cost. But that was also an opportunity to shift a little bit of risk, right? Because when you are self-managing, so for example, the city of Portland and then eventually the state, they put in some new rules around how you handle tenant applications, the process, how you inspect the unit. And so the amount of documentation that you had to do and the steps that you had to follow and the process of how you had to store all that had significantly increased. And so instead of building up the systems to go adapt to that, which would have been a cost, it was easier to then move it to a property manager that was already going to have to absorb that for their broader portfolio. And then on the risk piece, it's the amount of record keeping that you have to do just to keep out of trouble. I mean, we're all going into this with the intent of doing the right thing. But it doesn't matter. You have to have just impeccable record management that goes back a period of time in terms of like every communication that you've had with the tenant, just in case of that worst case scenario. And, a property management organization, a third party management organization, they've got the scale already built to do that. And we could figure it out. But it was going to take an investment. It was just easier to move it to a third party property management at that point.
Yeah, no, it definitely makes sense. And that's kind of one of the things I tell my clients a lot of the time too. It's like, can you self-manage stuff? And it's to the point with a lot of different states too. It's, I would say, Florida is by no means Portland, but there's still, you still have bad tenants and you have bad actors not acting in good faith with, attorneys or other people that are just saying, hey, like, has this person not replied to you in 24 hours about your air conditioning? You might be entitled to compensation. So yeah, I can definitely see how that, definitely plays in. So, you start seeing some of the writing on the walls. You have all these different things, between like the increase of your cost basis of having, more professional services, the overhead of having professional management, and just kind of looking at, okay, well, there's really no ability to kind of reduce costs anymore. You're having to kind of keep up with these ever-changing legislation that's going to make it more expensive, whether you're doing it and having to build out those workflows, or your management company gets hit with a new piece of legislation, they have to do something. They're going to pass that cost on to their client, which is you. Yeah. So I'm assuming at this point when you kind of start seeing, hey, maybe there's some benefit to, not investing here. So maybe take us through the thought process of when you go, okay, you know what, let's start moving out. Was it a fire sale? Did you do a kind of line by line? And then how did you actually go through and identify which market you thought would be the best? And what were some of the criteria that you used to help identify what market you wanted to shift your investing to?
Yeah, it's a good question. So I would say it's about 5 years ago, we stopped buying. So we hadn't purchased anything in 5 years. And then the question was, all right, well, how do we diversify outside of the state? Now, I was 50% partner with a partner for the local assets, but he was aging out of the business. And so he and I were not going to partner on stuff out of the state. So it was really more me looking to figure out how do I diversify outside of the state. So that was really what kicked off my efforts to just go bigger, because if we're going to go outside of the state, we might as well get some economies of scale, because I'm not going to be there. So I'm going to need to get partners that are more local to whatever market we want to invest in, boots on the ground, as you will, as they say. And so I started looking at the markets, just like everybody. I think from a high level perspective, it's like, number one, where are there landlord tenant rules that are more, I wouldn't say in favor of the landlord, but just more fair and more neutral. I mean, that's a good place to start. And then number two, where are companies moving? Where are jobs going? That's important. I mean, Portland was a fantastic place in terms of to live, and there was great companies, a lot of tech. We were kind of like a little mini Silicon Valley. It was just too expensive to live in the Bay Area, and so people were moving up here. But there's also other markets that have that same DNA. So where are people moving? Where do people want to live? Where are the jobs? And so the Southeast, the Northeast, those are pretty hot areas. Texas was doing well. We looked at Florida. And so then it was a matter of, right, well, how do I find that right team that maybe has more local incumbent knowledge than I do, and start to put those partnerships together for those specific markets that we want to be in. And so that took a little bit of time, actually longer than I thought. But I'm glad, because if I would have jumped in too early, I just would have been probably overwhelmed with kind of my lack of knowledge in any given market, and everything from local laws to some of the property managers, the ones that are great, the ones that are not so great, and so on.
Yeah. So from like the research perspective, I mean, it's so easy just to tell someone to Google something nowadays, which I find kind of lazy, but it is basically how you figure stuff out. And when you talk about figuring out kind of where people are going, if there's migrations and, like immigrations between states, or if you have jobs and other things like that going to certain places, were there any particular resources that you liked that kind of popped up and said, hey, this is what I'm kind of using as kind of a good, like good resource, but also accurate information for that kind of stuff, of how you kind of, numerically looked at, say, okay, here's where, I think job growth and other things are going. Were there any like particular resources that were good for you that you think people might benefit from?
Yeah. Let's see. I did. I think one of them was, I looked at like best places to live. That's a popular website that has some interesting data. It's not always up to date. Sometimes it's a little bit off, but I actually struggled a little bit on that because everything it's sort of relative, right? Like you can go to any local county or the economic development organization for that area, and they'll give you these numbers of like all the jobs and all the companies that are moving in. But it's like, okay, well, so what, who cares, right? Is that going up? Is it going down? How does that relate to other markets? You kind of have to look at it in totality. And so one of the things that I actually did was I started grabbing offerings from other deal sponsors and other groups to kind of see what were they putting in their offering to really promote that local area. So like I knew generally, let's say I like North Carolina. Okay, well, who's doing deals in North Carolina, looking at some of their offerings and then saying, okay, well, where, a lot of times you can see that data. Sometimes they tell you where they got it from. I would then dig down into that to get a little bit more color and specific. So I actually started with other sponsors and started borrowing some of their content to figure out their sources and then doing my own research from there.
Well, that's a really interesting perspective of, taking a look at, those big prospectus packets that everyone should be reading, but maybe they aren't. There's a lot of good information in there. By virtue of my job, I've gotten to read through some pretty interesting ones. I'm kind of a nerd like that, and I enjoy reading 130-page offering memorandums, but not everyone does. But that's a really good point. They got to do a lot of research to solicit an investment, so why not use some of that to your advantage to figure out, hey, like, okay, great, this might work, but maybe that's not the right flavor for me. Let me look at somewhere else and kind of start doing that. And that kind of leads really well into my next question of, whenever this all of this stuff takes a tribe, it takes a village. It's not something that any one person goes out and does this alone. And I'm confident with saying that with nothing's 100%, but let's just put as many nines behind that 99% as you want to. How do you go about finding people? It's, we get kind of insular and, it's, besides just maybe a network of friends you have just by virtue of maybe professionally or if you're involved in some type of social activity, how do you find someone, across the country or find a group of people and, not only meet them, get to know them, vet them, and then feel comfortable giving them tens, hundreds of thousands of dollars of your money to be good stewards of your capital?
Yeah, no, it's a really good question. And I really struggled with that initially because I think like a lot of people that are trying to maybe ramp up their real estate business, I was trying to network and talk to so many people. And I was having so many surface level conversations that, yeah, we had a good conversation, but then, it didn't really go anywhere. And, my database is growing. I've got all these people in my CRM, but, again, so what, who cares? How's that translating into kind of actionable next steps? And so at the same time I was doing that, I was also trying to build up broker relationships directly. I was trying to run a couple off-market campaigns, and it was really too much at one time, and I was spread too thin. And so one of the things on the partnership front that I ended up doing was, let me take it down to who are the top 3 people that I really would like to go work with. I like what they do. I like their business. They're way ahead of me in that particular market. So there's some built-in risk mitigation there. And so I narrowed the list and then put all of my energy into those 3 people, trying to build a relationship and get deeper, get to know them a little bit more. And, one of the guys that I ended up partnering with, I used to check in with him and just check and let him know, hey, what's going on? What are you working on? Hey, just been raising some, kind of working, building up my investor list. And, I'd let him know when I got a new commitment, somebody that said, hey, I can do 100K or I can do 200K. I remember I one time reached out to him and asked him if he had, if I could use his deal that he was working on at that time as an example of a sample deal for one of the investor prospects that I was talking to. And so I just kept that engagement and kept working that one individual. And I actually was about ready to give up. I remember I've got this place out on the Oregon coast. I'm sitting there and it was like, that day I was like, what, it's not working. We've not come to an agreement to work together. I know he's got a deal and, I've got all kinds of reasons why he could bring me in, and he hadn't done it yet. And so I was going to go shift my strategy. And that same day he called me and he said, hey, Chris, we got this deal. You want to, here's what it is. You interested in maybe joining the team? And I said, but I need to know in 24 hours. So, we ended up jumping in, and we've done multiple deals together, and it's been a good relationship. but it was focus.
No, yeah, absolutely. No, that's one thing that, I try to get across to people. It's, if at first you don't succeed, try, and just keep trying.
Yeah.
Eventually something will stick. They say throw something at the wall and see what sticks. Well, just you're going to be throwing a lot of tennis balls, but eventually something's going to hit there and it's going to stick. Now, with regard to those few people that you identified, how did you kind of identify? And I think that's a good nugget of something people can take away from this. Narrow. Just like if you're in business and sales, it's always good to, the more you can narrow that funnel and focus on things, the more successful you're probably going to be if you can, focus your efforts. It's always good to cast broad, but eventually you got to narrow that down. And the sooner you can do it to quality sources, then probably the better success you're going to have. So how do you go about saying, of the thousands of syndicators out there and all this kind of just mountain of data, even sifting through a good aggregate and a good CRM, like how do you go about finding those three people? What were some of the things that you picked? Did you pick like a list of things saying, hey, I want people that have X, Y, and Z, and then I kind of pick those out? Or was there something a little bit more analytical, or was it something as simple as just X, Y, and Z, and here's three people?
Yeah, I did have some criteria, and my criteria has changed over time. And there's some things that I better understand now that I would probably add to that criteria. But I had a little bit of criteria. They had to have done it for a while, had to have so many assets under management, deals that have gone full cycle. One of the things that I've added recently to my list is, I'm looking to work with people that have in-house property management. That makes a big deal, from an operational perspective, especially in today's environment. But I come from a sales background, and there's two ways to go out and sell. You can go out and try to touch as many people as possible, and one hit, maybe you time it just perfect, and that's great. But that's a little bit more of like an inside sales type of model versus you can be a major account manager, kind of, I wouldn't say hunting whales, but working big deals. And sometimes you have to place your bets and say, okay, well, for what we sell, this is a type of company that definitely would have the need for what we do. And then you have to dig in and you have to spend some time working relationships, digging deep, digging wide, and really work that one account from different angles with different ways and trying to solve different problems and trying to add value to that account. And it's no different with individuals.
Yeah, no, that's a very good point. So, you narrow this down, you find someone. What market did it end up being? You can be specific as a state or just a region, but where did you kind of end up settling?
Yeah, so North Carolina and South Carolina.
Okay. Now, what were the big things besides the people that you found there? Was it mainly based on legislative things, or was it just kind of like a melting pot of like, I found the good people, I found the people that are doing things that I want to do, legislation seems good. Was there something that stuck out more or less to you about that? Or was it, again, just kind of an amalgamation of everything?
Yeah, I would say it was more the people and the team, the locality, and then the people that were able to go find the deals in that market. Okay. And and the market was good. We liked the market. It was growing. Rents were increasing. Employers were moving in. So it checked those boxes. But that's great. But if you don't have the people and the team, it doesn't matter.
And one thing I wanted to ask you before we get too far ahead, you said one of the criteria of the people that you look to invest in was in-house property management. Now, besides maybe just the thing that kind of pops into my mind would just be, cost savings. You vertically integrate some of that stuff, and you have the ability to, just pay less if you're employing everything in-house. What were some of the benefits that you perceived of having, in-house property management being a good being a good thing to look for you? And that might not be it for everyone, but why did you specifically like that?
Yeah, it's really not cost, because I think, you're going to pay, you got to still pay your third party, even though they're in-house, right? You still have to pay salaries and you have to pay people. So it was less about cost and more about control of the business plan and the speed of execution of the business plan. And the last 24 months has been difficult in terms of labor and staffing. And the property managers, just like every other company out there, they're struggling. And so they don't have enough people. They don't have maybe the quality people that they would want to be in a particular role. Sometimes it's a little bit of a balancing act. They won't tell you this, but sometimes, they've got people that are covering multiple properties. Maybe they're covering twice as much compared to what they would have been covering 2 years ago. And so they're not delivering A-level service, and everything's slow, everything's delayed. We have logistical problems in the market. So when you have your in-house property management and you're not servicing anybody else, just your business, those are things you can control. And if there's something that's a higher priority, maybe there's an opportunity to more quickly turn a unit because rents are hot, you can go do that and just get it done faster. I mean, so it's really about speed of execution.
Yeah, I can definitely see that efficiency. And yeah, after I'd said it and you mentioned that, yeah, I could see where, in all honesty, having it and under your roof might honestly be more expensive, if you have to pay for things like, workman's comp and, additional, liability insurance policies and things like that. Honestly, maybe having it in-house might be marginally more expensive, but I think you make it up for it in the fact, like, just like you said, you have that control factor. You can, directly control. If you employ me as a property manager, I can give you a million excuses and you don't really have any recourse. It's like, yeah, my workers are X, Y, and Z. It's taking me this long. It's like, okay, great, thanks. Just get it done. Like,
Right.
Besides firing me, you don't really have any recourse. Whereas when you have that in-house, you have a little bit more eyes on it and say, like, okay, yes, like this is acceptable or no, like you have these workers, like put them to work. So
Yep.
yeah, that's an interesting point. I don't think anyone's really kind of made that distinction before of why having in-house property management might be a really big benefit. So yeah, definitely something to look for. So you've kind of, you've made the decision, you found these people, you're making the transition from the Pacific Northwest into the Carolinas. Now, how long did it take you to kind of sell out of your holdings in the Pacific Northwest and deploy everything over there? Are you still kind of in that process? I know you said that was
No, I
5
didn't.
years ago, or?
No, I didn't tell. We sold one property.
Oh, really? Okay, so you
Yeah.
just stopped investing new capital.
Yep.
Okay,
Yep.
gotcha.
Yeah, the way I looked at it was, hey, it's not perfect, but that capital is already invested. And yeah, we've got some equity in these properties. But when we went into the and a lot of these properties I've had for 10 plus years.
Okay.
So when we went into the pandemic and, just like everybody else, I was freaking out. And so I started doing the math. It's like, all right, if tenants just stop paying rent, how far down do I have to go to the point to where we're breaking even and I can't cover the mortgage? And that actually gave me a lot of calm, because at that time it was, I can get all the way down to 50% of tenants not paying. And, it's still not ideal, but we had paid down some debt just from the process of holding those properties. And so, we've got a lot of great cash flow coming from those. So I looked at the portfolio. We sold off our lowest performing asset, maybe kind of a C- type of property. And that was the one that was causing the most headaches. And that has freed up a ton of mental cycles for me. And then everything else, I've got a great kind of niche property manager that really focuses on the smaller multifamily. And his organization is lean, mean. And, we pay more to turn a unit here than we do, like, for example, in North Carolina. That's just, things are more expensive here on the West Coast. And so there's nothing I can do about that. But still, we're making money. Cash flow is great. And might as well just hold them and let them keep generating cash flow to fuel other things that we want to invest in.
Fantastic. Okay. So, and you said that transition happened about 5 years ago. So had you done your first deal in the Carolinas before COVID?
No, it was early beginning of COVID.
Oh, wow. Okay. So, so you make that transition, and you mentioned when we had talked before, you started using some of your, skill set that you had learned in high tech sales to kind of help, with your adjustments. So maybe let's talk about, we've gotten, the everything up until this point, and now I always like to talk to people that have actually that invested during COVID. Hindsight being obviously in 2020, the everyone's like, oh, if I just gone in there and just started buying everything, I'd have done great. But obviously in the middle of COVID, everyone's like, well, the world's about to be literally set on fire. So
Yeah.
investing is, wasn't at the forefront of everyone's mind. So, take us through some of the other things that you mixed in of your professional life, your high-tech career into this new transition, and also like what it was like investing in multifamily, doing your first deals in, literally clear across the country, about as far as you can get in the lower 48 during the pandemic in 2020.
Well, so, I wasn't necessarily afraid of investing during the pandemic, because after going through the dot-com bubble, going through the Great Recession, owning assets through the Great Recession, what I learned was, there's ups and there's downs. There's periods where the market's really hot, and then it's never really crashed from a multifamily perspective. It's just maybe slowed down. Maybe rents were a little bit flat. Maybe roommates were moving in and sharing units. So I wasn't too worried. And so I've always taken that approach of kind of a steady eddy, look for opportunities. But my goal is always just keep going, keep investing, keep growing. look for opportunities, maybe make shifts in market or asset classes or what have you, but don't stop. Kind of think of it like the old dollar cost averaging from a stock market perspective, right? Just keep doing it. So, again, and then doing it from afar, that was just the team, right? Having the people that have the relationships that are local, boots in the ground, that eased a lot of my concerns and worries. I still worry, but made it better. From a high tech sales perspective, one of the things I was looking at is I am engaging some people and trying to figure out where can I offer the most value, because I'm working with I've got a couple people that I've done all of my deals with so far except for one. What is my skill versus what is their skill? Where can I add the most value? And coming from a tech sales perspective, clearly I'm comfortable selling. Clearly I'm comfortable with marketing. That's what I've been doing for 28 years. And so I tried to jump in and say, all right, how can I make some of what we're doing better in terms of maybe how we promote the deal, how we do some of our marketing, how we do some of our communication, helping with, like, for example, maybe the offering document, the presentation, the Zoom meetings, the webinar that we're going to do. So I started to shift a little bit more with the team on the marketing and investor side of things. And then I really started to get interested in the capital raising piece of it. And so that's where, like, the brand that I have now is called High Tech Freedom. And one of the things I struggle with is, everybody's doing real estate, right? And everybody wants to go out and be in the business. And same with me, right? And I wanted to go raise some capital for some of the bigger deals that we were doing. But I was really struggling with my generic Pacific Pine Property LLC business, because who's going to hear of that, right? I mean, I'm just a blip, a minnow in an ocean. And so one of the things that I started to work on, and this was really early last year, was how do I niche down and maybe not try to tackle everybody out there in terms of my brand and my ability to raise capital, but focus a little bit more on a narrow audience. And so I came up with this concept of High Tech Freedom Capital. And it really was the goal there was, how do I go service and add value to people just like me, people that are in the high tech sales world, people that are high tech sales leaders, people that are out there, they're working 50, 60 hours a week with the opportunity to make fantastic money, making equity from stocks and RSUs, but maybe they don't have the time to go invest in real estate directly and buy, a Airbnb or buy a home, but want that real estate exposure. And I was fortunate to have a partner early on to kind of help me along the way to learn all of that. If I didn't have that, I would not have had the time to figure it out. And I think that's where a lot of my high tech friends are at. And so I just bring that up because from a, it was really not so much taking some of the tech skills, but taking my real estate business back to the tech world and addressing, I guess I'll wrap up with this, one of the big problems that I see and with people like myself, it's funny how in the tech world, you go out, you sell more, you make more, you get more commission. Well, guess what happens is they're making more. They start to spend more. And so I've met, many people in my industry that over the years, they get to that point where, God, I love, my kids are getting close to being out of college. I'd like to retire, free up some of my time, because it is a grind. When you have an opportunity for big upside, there's a lot of expectation of your time and you don't have a ton of freedom. And so they want to leave and do something different, but they've built up a lifestyle where their 401k can't maintain that same level of cash flow that they've been getting from their job. And I was fortunate, but it kind of opened my eyes that, why don't I go bring this to my peers and give them the opportunity to invest alongside of me as I'm pursuing some of these deals outside of the state of Oregon.
Cool. So it's basically kind of like, just a platform of like aimed at individuals in your similar industry that, we're trying to supplant some of that income they have from their jobs within the commercial real estate side of things.
Yeah. And in support of that, and this is actually how you and I met, is I have a podcast for tech sales people, nothing to do with real estate, but the premise of it is you do need to learn from the best in order to earn like the best. And then once you earn it, how do you take those hard-earned commission dollars and redeploy it in a way that can create additional income streams to help create that freedom that we're all looking to achieve. So it's fun. I bring on other really successful tech salespeople, entrepreneurs. I had somebody from your organization talking about self-directed IRAs and, what are they and why should people be learning about them as just an alternative way to invest in different assets.
Yeah, absolutely. My colleague Scott Maurer is how he connected us with this. And yeah, it's always interesting, especially talking to people because, I get to talk to people across all walks of life, whether it's, people investing in, self-directed IRAs are a great vessel for investing, in alternatives, but, that spans, especially in the high-tech sales side of things, the commercial real estate is an interesting connection that we have because so much of what we do here at Advanta is based in real estate, whether it's, commercial multifamily, industrial, single family, mortgage lending, all that stuff is, a big part of our AUM. But another big chunk of it, I'd say maybe 30% of our total AUM here is private equities, people investing in startups, whether that's equities, debts, everything from, secured notes, debentures, Series A, whatever it is, people investing in different startups. And, especially from the high tech sales side, people can see the huge upside of investing in something that, has a buyout or, goes public. And owning that stuff within a tax shelter, I have plenty of people that like, they're having to, factor in all this stuff. And they're like, well, great. I have, all these options that I, that I exercise or have all this equity. And now I'm getting hammered with taxes, using IRAs past the real estate side of things for the private equity side of stuff is a very big benefit. So, that's one of the kind of the cool things about all of this, but not to kind of, I could go on for hours. I'm a big fan on that stuff, but to kind of bring it back into the real estate side of things, education is definitely, a big part of this. And I think that's what, big part of, what you've put out there is educating yourself on, what you can learn from what you're doing and also what you can learn from other people is huge. And that's something that if you listen to, I think this is our 53rd episode. So we just crossed over a full
That's awesome.
week block of doing this podcast. As many people in commercial real estate as I've talked to, that is definitely kind of a bit of an echoing sentiment. So I encourage people to take that to heart. If you're interested in doing this, that's a very good point to have. Now, looking forward towards the future, it's always good to look at the past, but with investing, it's looking at past to base what our present decisions are for a potential gain in the future. So what are you looking at going forward? I mean, it's a tough one going forward, not necessarily that we're in a recession or maybe even going to go through one, but money's getting expensive. Cap rates are getting compressed pretty handily, at least from the fact that the Fed has just been thankfully, we only had a 50 basis point increase this week instead of the 75 point that we've been kind of used to. But, rates are still going up. Money's getting more expensive. The meat on the bone for some of these deals is getting thinner and thinner, which, increases the need to do your research and buy right and have correct metrics for, what you're doing. Has that changed anything for you on, what you're looking at in the future with the cap rate compression that we're probably going to see over the next 3 to 4 years with what's going on in the market right now with the velocity of money, the price of money, and, the price of real estate and rents and everything?
Yeah. I mean, there's fewer deals that I like. So it's definitely slowed some things down, I would say. We did just finish, we were a small part of a much larger deal in Texas recently. And, one of the things that I really liked about it was, and the reason why this deal was even able to be put together is because the person that put it together is 100% focused on this very specific submarket. And so completely off-market deal. They own assets almost immediately next door. And so when you have that level of market knowledge, that's a type of detail that you need to know to really analyze a deal to make sure that those numbers work. You can't just kind of plug stuff into an underwriting spreadsheet based on basic knowledge and hope. Yeah. And so I'm much more cautious. But, the part of the reason why I've been ramping up my capital raising over the years is really because I remember during the Great Recession, I remember sitting in 09, 10, we bought, the best property we bought was in 09. But I remember saying, gosh, if I could go buy like 10 more, because, there were some decent deals and everybody was scared. And so prices were coming down because there weren't as many buyers in the market. But the problem was banks weren't lending and I just didn't have enough cash. And so that I remember at that point, I said, I never want to let a recession or a bad market where there's opportunity, I don't want to miss out on that again. And so that was the number one reason why I put a lot of energy to really expand my network, to be able to, I don't necessarily have to have the money, but if I can pull together people that do believe that there is upside in that asset class, that's why I did it. And I do think that we're going to see some deals out there over the next couple of years.
No, absolutely. And that's another good kind of echoing point from a lot of investors that I tell people is that you don't have to have all the money for this. You can get creative with it. If you know someone that does have it, and by being a benefit to other people will benefit you. I can't remember who told me that, but it's one of those ones that kind of stuck with me, and I would love to credit the person because I'm not going to take credit for it. But it's just kind of that general sentiment of, you get out of the universe what you put into it. If you put in the hard work and you make those relationships, it will pay off back to you, in spades. If you know those people, you were value to them, they're going to be a value to you in the future. So, those are all, again, kind of, really great details. I think we kind of hit on the main things that I wanted to focus on today of, how to identify a pivot for you. It happened to be legislative. And I think a lot of people are seeing that. There's a lot of markets where I think that, and it also kind of brings up, other where there is detriment, sometimes there's opportunity. So, for some people, maybe you love dealing with the court system. You're one of those weird people that enjoys going to the DMV. I don't know. But, it opens up opportunity for maybe, if you're seeing people exit the market, that means that they're leaving. There's going to be opportunity. It may not be worth the headache. I don't,
right.
I don't know if Portland's, something that anyone wants to touch unless you're, Blackstone Capital and you can just do it. But again, just understand, where there's opportunity, where there's opportunity is sometimes where there's people leaving, not necessarily where there's people going. Yeah. But again, we're focusing on, your identification of that. Happened to be legislative. You found out, where it was a good place to do by focusing on a few small people that you really wanted to try to get better relationships with. You kept at it, didn't give up, got that done, and then had the workflows in place with a good team in the markets that you wanted to go into. So again, these things aren't, this stuff isn't rocket science, but it can be that basic. Is one thing that I love about talking to people that have been successful with this stuff. It's not like talking to an option trader that specializes in weird derivatives on some, on a market halfway across the world. Real estate can be that, kind of down to earth, very lucrative business that, so long as you have a good degree of conviction and you're a good person, you can make good money in it. So with that said, are there any kind of things that you wanted to touch on before we go? And also, if you have, obviously you have your system, your podcast and everything else, maybe let people know where they can find you and get in touch with you about that stuff.
Yeah. So a great way to connect up is I am Chris Freeman on LinkedIn. So if you go to the LinkedIn URL and then put in Chris Freeman, that's me. And you can hit me up through our website at hightechfreedom.com. But if you're in business, sales, definitely check out the podcast because I do have authors on there, some really interesting people. It's High Tech Freedom. That's the name of the podcast. And also, we're always looking for great guests. So if you're maybe, you're an entrepreneur, maybe you've had some success and you want to give back and share some career insights, please reach out. I'd love to have you as a guest on the podcast.
Absolutely. Well, Chris, again, thank you very much for your time today. I really appreciate you being on. Again, everyone, thank you very much for tuning into the Alternative Investing Advantage podcast. My name is Alex Perny, and we will see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.